254. Oh, boy. This is a blowout number. Over 100,000 more than expected on the September jobs report. We're going to see the impact of equities rallying on this. The economy is doing fine. Jobs market's doing fine. Maybe the Fed shouldn't have done that 50 basis point cut. Let's bring in our next guest. It's going to be Jenny Horne, markets contributor here on the network. Jenny, give me your take here on this number, 254,000. Are you kidding me?
And unemployment unchanged at 4.1%. Yeah.
4.1?
4.1.
That's down a tick.
That is down a tick.
Yeah.
But I mean, it's not drastically lower.
Mm-hmm.
I mean, if we start saying that the Fed shouldn't have cut, I'll be losing my mind. But employment did continue to trend up in food services and drinking places, healthcare, government, social assistance, and construction. I feel like that's been pretty much the theme where we've seen healthcare and construction be more of the resilient job ads on a monthly basis. But overall, among those workers, we did see that for adult men, that increased 3.7% that actually decreased in this month. Well, we also saw the jobless rate for women actually raise around 3.6%. All things considered, then I think you look at those that were not in the workforce, that was 5.7 million. That changed also little in September. So there's a lot of not necessarily I'd say nothing new, but it's also not bad.
Yeah, unemployment rate dropped to 4.1%. That's key. Revisions up 72,000 from July and August. That's a positive side. Remember, July and August missed estimates on the headline numbers there. So revisions higher, not lower. That's surprising. But then if you look at the wages, wages looks like year over year went up to 4.0%. Forecast was for 3.7, 3.8%. Average hourly earnings up month over month, up 0.4%. So wages continue to grow. That's going to help that inflation story. But does it also trigger, hey, that the workers are going to be out there continuing to spend when wages are growing up?
Well, I think we'd hope. I mean, the good old resilient U.S. consumer. But to break down the individual job components, obviously within each sector, food services, drinking places rose by 69,000 jobs in September, well above the monthly average that has been around 14,000 over the past 12 months. Healthcare added 45,000 jobs in the month. That was below its average at around 57,000 again over the last year. Employment in government did continue to trend upward, adding 31,000. Government continues to average around 45,000, so that was actually slightly below what the average had been. And social assistance increased by 27,000, primarily driven by these individual family services. That was up 21,000, also slightly below the average at around 21,000 jobs added over the past 12 months. Now, employment showed little change over the month in some of these industries like mining, quarrying, oil and gas extraction, manufacturing, wholesale trade, retail trade, transportation and warehouse, information, financial activities, professional and business services, and others. Well, yeah, I mean, there's still construction continues to add 25,000 jobs. That's above its average. Not a lot, though, that excites you, though, when you break down each industry. I feel like typically I look to leisure, hospitality. Yeah. That was not really a headline story of this report.
Yeah, that had been the headline for the previous 2 years, right? But now it's starting to even out a little bit. And I noticed on the JOLTS that construction work job openings started to ramp up because interest rates have come down. So maybe that's a component that's lending support to this overall number. Average hourly work week hours actually 34.2. That came in a tenth below expectations. But labor force participation rate, I mentioned this before the number came out. They were expecting that to maybe tick up a tenth or 2/10. That came in 62.7, so in line with last month's and the estimates here. Jenny, the impact here to the different areas within it. Nick Timmeros came out with something, revisions he was highlighting there, and the strength in the labor market, because we're at full employment right now, around this 4 to 4.2% as far as unemployment rate. But it's almost a bonus right now that the Fed is cutting during a growth cycle in the U.S. economy and a robust jobs market.
Well, I mean, I do think that this was one of the primary focuses of the last Fed meeting. I mean, they mentioned over and over again that the aggression of their cut, going 100 basis points, was due to the fact that they're trying to keep employment at a healthy clip. So I think that this is I mean, I didn't know if we expected to see this impact so immediate, but I do think that this is right. The Fed's intention is that they don't want to continue to see that unemployment rate tick up, and that's why I think that they're acting more aggressively. So I don't know if this necessarily could say the Fed is right, because I don't think we have enough time, but it's definitely, I think, encouraging based on the fact that labor was a major component of their last meeting.
Yeah. And I think there's going to be that discussion, Jenny, and I think this is really important. You mentioned that the outsized 50 basis point cut that the Fed did last month. That kind of, some people wanted it, the market wanted it, but at the same time, if you take a look at whether it was warranted, because the Fed kind of pivoted and said, hey, we've got inflation under control, let's worry about the jobs market, because we did see those cracks in July and August as far as headline numbers. But at the same time, does this make the pundits kind of go, well, why'd you cut 50 basis points if we're still doing well, wages are going up, and, we've got an outsized number, 254,000. That's over 100,000 more than they expected.
I know. It makes me confused, how you could have, so missed the mark. I mean, I guess not in a bad way, but yes, I totally think that it will make the pundits say, the Fed was too aggressive about a month ago. But I think that is too reactionary. I mean, we have to let the dust sort of settle here. I'm still much a believer in the Fed's course of action, because I did see their point of sure, we are continuing to see unemployment tick up. We're going to try to fix that. And I think that it's going to be more of a patient story here. It's not going to necessarily be immediately we can say the Fed was wrong or they were right.
Yeah. And if you're looking at some of the asset classes that are moving on this, dollar continues to be firm. It's up on this after the report. The dollar, this is, I think, the fourth day in a row. Dollars have exploded. We're over 102 level right now. But watch yields, because we saw Treasury sell off. Yields a 10-year now up above 3.92% at this point. That's the highest level that we've seen yields since about the beginning of August, when everybody was like, oh, the Fed's going to do cuts, and they're going to do multiple cuts, and we want a 50 basis point, where they started dipping on yields. But now we've seen that resurgence. Now it's up nearly 20 basis points since that Fed 50 basis point cut. I mean, what's that tell you right there, that those expectations of maybe that 50 basis point cut that the market wanted in November, that's gone now, right?
I mean, absolutely. I was just checking what now we're expecting for November. Everything says 25. But hey, how quick were we to jump back and forth on the last? I mean, I feel like it was a week by week thing where we'd get economic data. I mean, CPI, PPI, and all of a sudden everyone would say, it's going to be 25 or 50 again. So I feel like there's a lot of economic data to come out between now and then before we could say 25 versus 50. I'm seeing 25 right now, though.
Yeah, I think Fed Chair Powell laid out the case for 25, and this number did too. So yeah. Take away from that, great stuff. As always, Jenny Horne breaking down the jobs report with us.